Hello and good afternoon. I welcome you to today's weekly market outlook here for Admiral Markets on Friday, the 1st of February, 2019. This is Jens Klatt speaking, and we want to have a look at what to expect in the upcoming week of trading, what happened over the last days here. So where do we stand? And also, because it's a perfect opportunity here, we want to have a look also on the non-farm payrolls, which will be published today. So over the last days, there have been some indications that probably today's NFPs will be solid. There was a really good reading last month with 312,000 average hourly earnings being up at 0.4% above market expectations. And this week's ADP employment situation is also or came in quite solid. So usually this is an indication that today's reading is to be expected or can be expected to come in quite solid too. The funny in quotation marks, is that even a good reading is not necessarily or will not necessarily result in a huge US dollar rally here after the comments from the Fed last Wednesday. We want to have a deeper look in, and so that said, every rally which is induced, if there is a rally at all, that's something we have to emphasize here, is probably short-lived and probably interesting opportunity to sell the US dollar. Why this is the case, we want to have a look at here in the upcoming minutes then. Before we start, as usual, here we have to have a look at the risk disclaimer. Please make sure that you understand that trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not necessarily suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. For further infos here, you can see that it was only the first 3 sentences I now read aloud. Further infos on this risk disclaimer, you can find it on the website from Admiral Markets on admiralmarkets.com. We want to dig deeper into something which is interesting or important also from a regulatory perspective now for retail clients. There is a differentiation between retail clients and professional clients. Since August 2018, you may have heard about this, the so-called ESMA decision. What does this mean? Well, it means that now there's a leverage restriction for retail clients with a maximum of 1 to 30 for Forex majors. Forex majors like Euro USD, for example, dollar JPY or pound sterling against the US dollar, and 1 to 20 for other currency pairs, so-called minors or also exotic currency pairs. Let's say something like CAT JPY, for example, perfect example, because we want to have a look into the seasonal trade, which is currently playing out well. Let's see if it keeps on playing out, depending a little on whether also probably the trade talks between the US and China will deliver a solution, or at least the outlook for a solution, because everything else could induce a risk off and result in sharper capital inflows into the JPY, which would counter then this bullish outlook for CAT JPY. But back to the ESMA decision and their leverage restriction. So there's also a 1 to 20 cap on the leverage now for CFDs on indices like the DAX 30, for example, but also gold. And this is not the case for professional clients. So professional clients have no leverage restriction. Regarding the criteria which you have to meet here to be classified as a professional client, also please feel free to reach out to your Admiral Markets customer support. So in fact, that's something we want to see, or we will see a little in a few seconds here. Admiral Markets is available in many countries, and most likely also in your respective native language then. But nevertheless, what's definitely worth pointing out here is that there is a negative balance protection for retail clients under these ESMA decision. But according to the policy from Admiral Markets, there's also a negative balance protection up to 50,000 British pound sterling. Also, please feel free for further information to reach out to Admiral Markets here. And this is me, the face to the voice you're currently listening to. Here, the question with only a short answer. There are plenty of other reasons, but I'm currently located here in Berlin, Germany. And in Germany, where, by the way, there's also an Admiral Markets office, in Germany, we refer to Admiral Markets as the so-called DAX expert, based on a very, very, very competitive offering here, with the typical spread of 0.8 points during the main trading hours, which is making the DAX offering in terms of CFD trading from Admiral Markets one of the most competitive one in the German-speaking, respectively in the global CFD trading world. Also here, further information can be found then on the website from admiralmarkets.com. Here, one world, global offers. So it's not only Germany, where I'm located in, but also other countries where you can find an office from Admiral Markets. Also, not only in the European area, but also, for example, in Australia, but also Chile, for example. There also further informations can be found on the website. Here are the contact details, and then we want to have a look here at our agenda for today. So the questions we want to answer are, what are the key economic events in the coming trading week? We want to answer the question, what's the current bias in the FX, equity, and commodity markets? And also, which trading opportunities may arise? And then we switch over here to the chart. And probably we do not start out with the Euro USD here. Probably we'll start out with the DAX, even though I have to say it's kind of surprising. Yeah, probably. Let's start with Euro USD. Why not? I mean, we have to talk about this here, so we can start with it and then switch over to the DAX from here. So after last week's ECB decision, we can definitely say that the ECB was all in all quite dovish in their remarks, or in her remarks here, and pointing to some let's call it difficulties or an economic slowdown in the overall euro area, especially pointing towards Germany. And yesterday there was, as you probably have seen, let's go here to a 50-minute chart. Probably this is even better. You can see that in the last hours of trading. 1 second. Last hours of trading. So in the afternoon, here there was a significant push lower in the Euro USD. Yes, we wait for the update. We are patient. There we go. So there was a sharper push here lower after this push higher. What was that? Well, that was the Fed rate decision. I want to be honest, so I didn't put a big focus on it in last week's webinar on Friday. And also, you can't really see any big details being published here, or being mentioned in our weekly market outlook in the written format, which is published then on every Monday around 10-11 a.m. German time in this case, so 9 to 10 a.m. London. There wasn't in fact big hopes also from my end, or big speculations or big expectations around the Fed that there will be something which is really new. Now, the thing is that last Friday, in the last hours of trading, as you may have seen here, there was a sharp rise. And in fact, it wasn't only a sharp rise on the 25th, but but also we closed above the highs, which were marked here on the highs of the ECB day. So there was a delay in the reaction to the quite dovish ECB, in my opinion. With the reaction here was probably countered by the comments from Ross Wilbur, U.S. Commerce Secretary, who said at exactly 1:30 London, when the press conference with Mario Draghi started, that the U.S. and China are miles and miles away from a trade resolution, something we want to dig deeper into than in a comment which was mentioned yesterday, and is the probably best reason to be found here why the DAX fell sharply. Then after a stint towards 11,300 points, and can't really find a buyer today, let's say. So we really can't catch a bid here, most likely because the numbers from China also, the Caixin PMIs, which were published overnight, came in significantly below 50, pointing towards also a global, not this global, a Chinese slowdown in terms of economic growth here. And yeah, so let's come back here to this push higher. What happened here? Well, it was only speculations back then. It was an article from Wall Street Journal which said that the the Fed here will probably start to be more flexible in terms of their balance sheet runoff, which started in 2018 and in the middle of 2018, and then resulted in a push also higher here in yields, in US yields. It wasn't only the outlook that the Fed will most likely hike rates or keep on hiking rates and continue with a rate hike cycle in June, then in September, and also with a fourth rate hike in December, as it, by the way, happened. But it was also the speculation that the Fed will rather sooner than later continue or run their run of the balance sheet then on autopilot. That was also the communication which was given by Fed Chairman Powell at the meeting then in December. And the interesting thing about this was that or not the really interesting thing, but it was most likely also one of the reasons why volatility stayed elevated, let's say, in equity markets. And it was, yeah, market participants started to fear that the Fed will probably not necessarily intervene then if market conditions become more volatile or worsen to some extent. Can we really trust that the Fed will then also stand up and say, no worries, guys, we are here to save the equity markets, let's say, step in as a buyer of not necessarily equities, but probably bonds here, run a QE4, whatever. And so the thing is that there were fears, and then at the beginning of January, with Powell already, the Fed Chairman Powell stepping up and saying, well, we are flexible. It was the starting point of a significant rally in equities itself. Here, as you can see, it started already, by the way, shortly after Christmas, with the comments from Stephen Mnuchin here, bringing in the plunge protection team and everything. And we never really looked back here from the 4th of February. That was also the day when the last NFT report was published. We never really looked back, but the Dow Jones here pushed significantly higher, starting the 4th of January here at 22,000 and around 700 points. Something, and today we're trading back at 25,000, so significantly higher, and overall with a gain of more than 8, something like around 10%, in fact, in January. So one of the strongest months and performances in equities ever seen. So it wasn't only Powell's comments here, but then also last week on Friday, which, by the way, also pushed gold higher. That was also one driver for gold higher. So you probably recall that I said gold is still very attractive from a risk-reward perspective in the current region. So we traded around 1,280, 285 or something, 282 if I'm not mistaken, when we had our last weekly market outlook webinar. And I want to be honest, I didn't expect what happened then in the hours after, but I started to call the week, and then I went to the gym, and in the evening I returned at around 10 p.m. German time, looked at the chart to prepare some charts for some articles, and was just really irritated to see trading gold above 1,300. So there must have been something. There must have been something which just happened, and it really happened. The Wall Street Journal, and now we come to the thing. The Wall Street Journal came out with speculations around the Fed probably becoming more flexible in terms of the reduction of their balance sheet. And That said, it resulted in a push higher in gold while the US dollar was under tremendous pressure. And this also was then the driver higher here in Euro USD. And yeah, well, now the thing is, it was only speculation, and these speculations became a fact last Wednesday when then, and here I have prepared something, the Fed statement read that the Fed is prepared to adjust the balance sheet runoff in light of economic and financial developments. So a clear message that they will definitely consider their autopilot program here becoming more flexible then. And this is something which is really keeping pressure on the US dollar high, and which is, by the way, when looking at today's non-farm payroll, something which is which is something that you have to consider when looking at the expectations around the non-farm payroll. So here's the economic calendar on the website from Admiral Markets. You can find it, by the way, on admiralmarkets.com. Then going here to the analytics tab, and while you find the written report, the written weekly report, but also several technical pieces over the week of trading then every Monday, Wednesday, and Friday. You can also find here the Forex Calendar, which you can then adjust to your personal preferences and individualize, let's say. And today we are looking at not only today's data, but also the data for the upcoming week then, with the high impact then for the G8 currency universe. And here in this context, you can see that today, obviously, non-farm payrolls are expected to come in at 165, 166,000. This is the consensus or the forecast. Let's see how these numbers come in, especially probably we can also extend the filter, which I won't do right now, but you can believe me, if I extend the filter, you will see there is a number which is probably even more interesting today, which is the average hourly earnings coming in at 0.4 last month, above expectation, and today being expected at 0.3. So if these numbers come in, let's say the forecast is 165, the numbers now come in at 180, probably 200,000, following the strong reading from Wednesday when the ADP data set came in above expectation at 213,000, if I'm not mistaken. And average hourly earnings also coming in as expected, 0.3, 0.4. This is countering the dovish remarks from the Fed here, and probably, let's say, stabilizing the US dollar a little. But nevertheless, it's probably short-lived, because all in all, this is what is currently driving the equity markets also, and which is currently capable also on pushing the US dollar lower, which means nothing more than every good reading today around the non-farm payrolls is most likely being countered in the next days then here by the expectation that the Fed will probably follow their quite restrictive stance over the last month and over the last year in general. Will most likely follow here with a very, very dovish stance in the months to come. In fact, something I haven't prepared, but also you can look up yourself when Google the Fed Watch tool. You can see here the probability of market participants to expect a rate hike. Well, by the way, let me just Google this. Fed Watch tool probably takes a little since the website is loaded here. But what I can tell you is that when looking at the rate hike expectations among market participants, what you can see is that till December 2019, the majority is really expecting a rate cut. In fact, we are over 90% of market participants expecting a rate cut, or the Fed not moving at all in terms of rates then, and only slightly, probably something around 5% of market participants expecting a rate hike of 25 basis points. If we remember how this picture looked around 3 months ago, well, we remember that in this September, I think it was in September 2018, expectations still were quite high. Market participants expected the Fed to hike 3 times, probably even 4 also in 2019. And we went from 3 to 4 rate hikes to 0 within nearly 3 to 4 months, and also on the balance sheet runoff here, running on autopilot, now being flexible. So the credibility of the Fed probably suffered a little, let's call it that way, over the last days. And it also points to some dark clouds being seen on the horizon here in terms of the economic expectations for the months to come here, and which is also underlined, by the way, for a reading. So this is, by the way, let me just, before I start now to talk about the Chinese data which came in the overnight here, let's come back to the Fed Watch tool. So this here is the current rate we are trading at, the target rate for the 20th March of 2019. This is the next Fed decision here. So you can see nearly 99% do not expect anything to happen here. No rate hike and also no rate cut. And now what we want to do is we go to December 11th, 2019. This is the last rate hike here, and look at this. So currently there's not one market participant expecting a rate hike, but instead it's 80% seeing 225 to 250 basis points. So no move at all. This is the current level we're at, and nearly 20%, slightly more than that, expecting a rate cut. So you don't expect a rate cut in favorable economic market conditions, or under favorable economic market conditions, let's say, which is a clear sign of trouble being expected ahead of us, and an economic slowdown, let's call it. And with this in mind, well, the thing is that so far you probably see short-term bullishness in terms around good NFPs today. Again, and I just repeat what I already said, but you don't necessarily expect a solid or a sustainable takeoff from the US dollar, but in fact you probably only expect a short-term rally, which is then sold off again, and any bounce here is most likely to be sold, which is very interesting, especially when looking at the euro then. And there we come to this market we are looking at. So what I'm talking about here in this context is, well, you most likely will say, hey, cool, then Euro USD is about to break out on the long side, right? And most likely to gain momentum and push as high as 116, 116.30, and probably even higher than that. Well, let's say I think this is the most likely outcome, but it's not necessarily driven by euro strength, but it's most likely driven by US dollar weakness. And I'm still very, very defensive and not necessarily overly optimistic or when it comes to long engagements in the euro. The same is true also for short-term engagements. So what I can say is today, for example, I'm holding a euro long position, euro JPY long position, and it's a purely a technical setup, in fact, and I don't feel overly optimistic about it, even though the trade so far is showing a small profit, and I still hope that it will reach the take profit level, which is somewhere above 125, 125.30. So in fact, I have to look it up right now to give you an exact number, but I don't feel I don't feel overly optimistic about it. I don't feel really good about it from a gut perspective, even though from pure technical perspective, respectively not technical perspective, but from a trade setup perspective and trading with an edge and with an advantage, everything's fine. So I just follow the rules of the trading setup. Why I'm skeptical about the euro, nevertheless, from a purely discretionary perspective, is the comments which were delivered from ECB's or not ECB's, but it's Bundesbank Whiteman yesterday. I'm sorry. So here yesterday, and that was most likely the reason for the push lower in the euro here. ECB's Whiteman says bad news from the German economy could continue for a while. Well, what is he talking or referring to here? Well, he's talking about the latest numbers, which really did not meet expectations, but came in below and showing an economic slowdown for the European not only for the European economy, but also and especially for the German, which is, by the way, also, which is very interesting. And keep this in mind when we talk in a few minutes about the situation around the Brexit and pound sterling, potential concessions of the European Union being made, when they are most likely made, and all this. So we still have the situation that Germany is the biggest economy of Europe, and here Bundesbank Weidmann, the chief of the Bundesbank, let's call him the Draghi of Germany, probably. Even though we have the ECB, but just to keep in mind, we still have the Bundesbank here too, and he is the chief of the Bundesbank. So he is very, very conservative in terms of the expectations, economic growth expectations for Germany. And with this in mind, and also, by the way, yesterday there was a tweet. I haven't prepared this here, but Zero Hedge tweeted that there are now also signs in Italy that here the Italian economy, based on numbers which were revealed from Istat, it's Italian statistics, economic statistics, which were published yesterday. From a technical perspective, the Italian economy fell into recession here for Q4 2018. Today, numbers for inflation were published. Core inflation was up, but here inflation numbers were all in all, when taking into account energy prices, oil price and all this, were lower here. No big surprise after the drop in oil prices, but nevertheless, or in energy prices in general, but nevertheless, we have to be really, really careful, in my opinion, about long engagements from a purely fundamental perspective. So there's no real fundamental driver for euro strength here, which is why I'm very, very conservative when talking about long engagements, even though short term, I just hope, especially for today, that the euro will probably push higher and most likely react in a similar fashion as it did on Wednesday. So in fact, dollar JPY pushed lower. And by the way, that's also something we should keep in mind here. But then the JPY followed and countered the initial bullish move in Euro JPY, for example. So this is only short term, in fact, and I just hope that it will be similar and probably plays out a little better than it did on Wednesday. So short term, I had also a Euro JPY long trade on, and I saw the market moving in my direction. Unfortunately, it didn't hit my take profit level on the upside, but fell short to do so around 10 pips, and then fell lower and closed the day slightly in the red, in fact. So it never, or it didn't even make it on break even for the day, but it fell slightly into the red, which is no big problem. In fact, since it was only a small loss, nevertheless, I would have appreciated 10 pips higher move here on Wednesday. But nevertheless, the thing is that also dollar JPY here is most likely to push lower, which is also something I pointed out here in an article, technical piece you can find in the Traders blog on the website from Admiral Markets. Let me just switch over here. And this is also the most likely outlook then for the days to come. It's really, even if numbers surprise on the upside now for the non-farm payrolls today, which is most likely short-term bullish. There's the article, Traders block here, as I already said, analytics, and then the Forex Calendar. There's the Traders block below that, and there's a short-term picture being drawn here for the dollar JPY, and also here you can see short-term. I'm probably a little positive, let's call it. It's also something which is illustrated here with this short-term push higher. Let's say probably a little above 109, but I don't think it would be sustainable, even if numbers come in better than expected, because the overall picture is not very favorable for dollar JPY long engagements. But in fact, it's very, very bearish, and that has also something to do not only from an economic perspective here. Okay, so it's not only an economic perspective. Oh, let me just see, where do I have this? here. It's not only that Germany and the US are seeing some economic headwinds, let's call it, but also the Chinese, where I already referred to the Caixin manufacturing PMI in the morning, coming in significantly below 50. This is the let's call it growth threshold, or the threshold showing or pointing to economic growth, but it's also the lowest level since February 2016. So all in all, this is something which is not very favorable. Short-term bullishness in equities, nevertheless, is something someone would probably expect based on the fact that this is something which draws or points to potential short-term expansive moves or more liquidity being delivered from central banks, in this case then from the People's Bank of China. But overall, it's nothing which is very, very favorable in terms of, from a fundamental perspective, which is favorable for equities in general. So someone should be really, really careful here around this. And not only that, but it's also that still we have fears around an escalation of the trade war between the US and China. This is also something which is most likely to favor risk-off moves and something to favor the JPY in this case, which is something which is also a little difficult then to be overly optimistic for example, a seasonal trade like CAD JPY. This is something we want to look deeper in a few seconds. Or respectively in general, long-term engagements in the equity markets, something we want to see then in terms of the DAX in a few seconds. Yesterday, there was this headline here. The Wall Street Journal pointed out that China and trade negotiators from China proposed a meeting between US President Trump and the Chinese Prime Minister Xi Jinping here in China in February. The translation of this is really, it's I think it's quite obvious what's happening here. Remember, last week we pointed out, not only in the webinar, but then also in the weekly outlook in the written format on Monday, we pointed out that there is right now negotiations going on between China and the US. And first results should be then expected being published on Thursday. That was yesterday, in fact. Wednesday, Thursday, and then the first results should have been published. Nothing happened, in fact, but it was more that the Chinese said, well, probably it's better if our heads, which is then US President Trump, and in case of the Chinese people, Xi Jinping, meet here and discuss further potential solutions to our current trade policies, and how to avoid overly confrontations or overly aggressive confrontations between the US and China here, since we do not find any solution here in our negotiations. And this is something which is most likely the reason why the DAX then yesterday sold off here, why the JPY was still quite stable. So the DAX, in fact, let's have a look here. So the DAX here yesterday, after an initial push on the upside, pushed lower and fell below, from a technical perspective, in my opinion, important level around 11,130, 150 points. So I didn't take it out, but it's the green line, but it's not a support anymore, but it's more like an orientation. And everything which is now trading below that level is most likely to see further losses and another retest of the region then, by the way, of 11,000 points. So in fact, from a technical perspective, we are still in a bullish environment, even though after yesterday in a neutral environment. What I'm talking about is the following. When looking at the hourly chart and zooming out a little, what you can see is a sequence of higher highs and higher lows, which was forthwritten here last week on the 25th then, or 24th, 25th, after the comments from the ECB being considered to be more dovish. But nevertheless, the thing is that now these effects, potential positive effects on equities from the central bank perspective, dovishness in the ECB statement, potential flexibility in the run-up, or not only potential, but a fact. It's a given fact that the Fed will be more flexible regarding the runoff of the balance sheet here, which is also being considered dovish. Very mixed data coming from China, also initiating or most likely initiating a more dovish stance from the PBOC and more liquidity being provided here. All this is pointing to higher highs than in equities, but this is countered more and more by fears around those trade negotiations between the US and China. And with this in mind, the overall picture is the complete opposite here of being very positive. And after, by the way, in the morning, we failed to make it here significantly back above 11,200 points, and now seeing lower lows. I mean, I have no real opinion on the impact from the non-farm payrolls then today, but given the fact that currently the market is looking for lower lows instead of higher highs here over the last days and failing here really to take on momentum above 11,200 points, the most likely outcome is even if non-farm payrolls disappoint, which is probably then where bad news becomes good news and is most likely to let equities profit short term, since it makes the flexibility and a more dovish stance in this case from the Fed in the US then becoming more likely. The thing is that in the current market environment, bad data is then also most likely to drive a bad mode or a bad buy or adding to a bad bias already being among market participants, more skepticism arising and then driving equity prices also lower. This is something which is currently, based on the current bias in equities, the most likely outcome. I mean, let's just see. The main focus in my trading, in fact, is when the non-farm payrolls being published is definitely FX and gold, especially. I'm not necessarily looking at the equity prices here, but when looking at equities, I think the current bias is most likely to be found on the downside, and any disappointment here is most likely drive prices lower, while better than expected reading is probably only short-term bullish, pushing equity prices slightly higher, and then fears arise again that this is probably holding central banks back here in terms of more liquidity, or providing more liquidity then. So yeah, this is the current picture. So after yesterday, I become short-term skeptical, let's say, in regards to further gains, and probably we are about to see another push in the days to come in the DAX, then lower, a push back below 11,000 points, which is, by the way, also then depending on the aggressiveness of such a push lower, the most likely driver for probably another stint towards, not necessarily in the week to come, but probably in the weeks to come then, and into the second half, let's call it, of the first quarter 2019, is most likely to drive us lower down to 10,200. 10,300 points, and probably also towards 10,000 points in the DAX. So probably we haven't yet seen the lows. And also remember, from a technical perspective, then looking at the US equities, the overall mode here looks very extended, is most likely driven by a pure, let's really call it, market manipulation from the US, from the Fed, from the White House, and here in this regards, especially pointing towards the U.S. Treasury, Steve Mnuchin, who brought up the plunge protection team, for example. So this overall push higher is it's not really looking very promising. And not only that, but it's a retest of the 200 simple moving average here. Now not from the upside, but from the downside, after we really fell into a potential bear market territory. And not only that, but also when looking at the all-time high here, and then not only having the all-time high, but the 2018 highs, and drawing this feeble retracement levels, then here you can also see that this is a 61.8% retracement, which is also, from a pure technical level, it's a quite deep regressive move, which is probably, when looking at this structure here, looking a little extended, and probably the corrective move is losing more and more its steam and pointing to lower lows, which is also adding then to skepticism and a potential push lower below 11,000 points in the DAX, then driven by US equities. So yeah, so if we combine all this, what does it mean? Well, it most likely means that probably gold is seeing probably a slight consolidation at an elevated level, especially if the NFPs come in better than expected. But overall, a corrective move, if it happens, and if we really dig a little deeper here, down towards, let's make the numbers round, 1,300 USD plus minus 5 USD per ounce, I think it's most likely that gold will continue its push higher, even if the seasonal pattern, the bullish seasonal pattern, which will end on the 5th of February. We made it already a topic, by the way, on the 11th of January. I looked it up today to just have a number I can present you here. So on the 11th of January, we pointed out that gold is most likely push higher. That's when we traded here around 1,280, I think. And in fact, yes, we pushed higher. And so far, it looks as if this seasonal pattern plays out once again. It did, by the way, over the last 20 years in 75% of the cases, or 15 years. But I'm not necessarily done on the upside, even if this seasonality is about to end here. I see further gold strength based on everything I just presented, and summing it up, I see further gold strength and most likely another test of the region around the 2017, 2018 highs around 1,360 USD per ounce. So this is, if I had to pick one market, I'd definitely pick gold right now. Short-term corrective move down towards 1,300 USD, probably initiated by good NFPs today. Let's see if this really happens or not. By the way, if numbers come in below expectation, I think this could result in another sharp sell-off in the US dollar, then into the weekly close, and a straight push higher in gold. But from a risk-reward perspective, I just hope for this pullback to happen, and it really happens. Well, that would be really nice, because I consider the region around 1,200, 295, 299. Round number 1,300 USD plus minus 5 USD to be a really attractive long trigger. And we have also a quite clear number on the downside to calculate our risk around 1,275. And the risk reward is, I think, really attractive, since it's significantly better than a 1 to 2 here, with a target around 1,360 USD per ounce, the 2017-2018 highs. So yeah, let's just see if this plays out or not. Next week, Friday, we'll talk again with the weekly market outlook. I hope you enjoyed the webinar, and I hope to see you soon again next week then, Friday. Also, again, I want to point here to the website from Admiral Markets and the traders blog, where you find the written piece to this webinar on Monday, and also the outlook for gold, by the way. I can already say that. I prepared it already in my mind. I only need to read it, to write it down, and then you'll find it here in the traders blog section and via analytics here too. And that's it from my end. So all the best. Happy trading. Watch your stops. Enjoy your weekend. Enjoy yourselves. Talk to you again next week on Friday. I look forward to it. See you, and bye-bye.